Okay, thanks for joining me. Today I'm going for a past paper. It's going to be June 2014 ACCN2, specifically questions 2 and 3. So I'll be going through an income statement, a statement of changes in equity, and a T account for disposals. So this paper is now free to access for anyone. It's not just teachers. I know teachers can get like a special login which allows them to see papers earlier, but you can now get it on the AQA website. Just type in AQA accounting past papers and it'll come up. Make sure your exam board is AQA, of course, because some people do different exam boards, of course. So for the income statement, they've done like well, the majority of it in a sense. We just need to pick out the expenses from these values here and then get to our profit figure and then change it a few times because we've got interest and tax to take into account. So anyway, first of all, I just highlighted two things. Depreciation charge for the year and provision for depreciation. Obviously one of these is going to be an expense, but in a way it's not simply enough to say, oh, it's the depreciation charge for the year, that's the one that goes into the income statement. What the real reason behind it is, depreciation charge for the year, well, that'll be for the year ended 30th April 2014, and that's what we want. This income statement is for 1 year only. The provision for depreciation could be 2, 5, 10 years old, and we don't want to include that in our income statement for a single year. So depreciation figure is just this year's depreciation, which is 257,780. And there's one more expense in here which is directly below the charge for the year, which is the director's remuneration. I hope I'm pronouncing that right, I'm probably not. And that's 240,000. It doesn't come up a lot. I think that's the first time it's ever actually come up, director's remuneration. So just remember that is an expense. And there's none others after that. Dividend paid, that is never an expense, although you might think it is not an expense. Retained earnings, share premium, non-current assets, tax, none of that's an expense at the moment. So now we're going to add up these 5 figures here to give us our total expenses, which is 113,860. So this is going to give us what we call operating profit. So what I'm going to do is just going to get my gross profit up here and just take away my total expenses, which brings me to 574,940. So there's 2 things I'm going to take away from my different profit figures to get to my final profit, which is the profit for the year, or net profit. You can use that name interchangeably. So the first one is going to be our debenture interest. So basically it's a finance cost. And it's actually given us that directly, which is just 36,000. So that's taken away. So this is going to bring us to our profit before tax, which becomes 538,940. Okay, however, they have given us debenture interest, which is very nice, but they could actually ask you to calculate it, which is very simple actually. You see in the top line here we have 6% debentures 2024 to 2026, 600,000. It's it can be confusing, but simply the amount that you will pay each year is 6% of 600,000, which is 36,000. And the date simply means that's when that's when it ends. So what you do is you'll pay interest, this 6% interest every year up until the final year, and in the final year you'll pay the full amount. So you'll pay 36,000 every year up until, let's say, 2026, and then you'll pay 600,000. So that's how a debenture works. It's not just a bank loan in the sense where you just keep paying each amount every so often. You might think that's ridiculous that you're paying 36,000 every year and then a massive 600,000 at the end. But you have to take into account obviously interest, and the time value of money is going to actually decrease the value of this 600,000. So that today may only be worth 400,000, so in a sense, because it's over 10 years from now. So I've got my profit before tax, so I'm just going to put my taxation in. And we're given that taxation for the year ended 31st of April 2014, that's right, so 107,788. and this is just going to give me my profit after tax. So it's basically my my profit for the year, which is simply 431,152. So that's the final answer. 431,152. So with that in mind, we're now asked to do a statement of changes in equity. So basically, I've done the outline of it. These values here are just they're given to us here. So the issued share capital, that's just my ordinary shares, 1.2 million. Retained earnings, that's given to us, 876,590. I've just added the 3 up, including the share premium, 300,000. So issue of shares. Where have I got that from? Well, I've got each of these titles simply from the additional information which we're going to use for the statement of changes in equity. So on the 1st of April, the directors made a rights issue of ordinary shares. The issue was made on the basis of 1 new share for every 3 shares in existence at a price of 35 pence per share. The issue was fully subscribed. So, rights issue. How are we going to go around this flow? We're going to calculate the number of shares currently in existence. So, how am I going to do that? I'm just going to take my share capital, the 1.2 million, and each of these shares are worth 20 pence. So I'm going to divide by 0.2. The 0.2 represents 20 pence, and that's going to give me 6 million shares. So 1.2 million is the value of the shares, 6 million is how many shares there are in terms of just, that's how many there are. So the number of new shares. So I have 6 million currently, and oh god, it's going to be a divide by. So it's on the basis of 1 new share for every 3. So 1 new for every 3. So I'm just going to divide it by 3, which gives me 2 million new shares. Okay, so I've got 2 million new shares. So I've started off with the value of the shares. I've moved to how many shares I had, and now I have the number of new shares. So I need to go back to the value of them shares. So I've gone from value to how many there are, and I need to go back to value. So to calculate this, we're going to have to do our ordinary shares and our share premium. Sorry. So we're selling these shares at 35 pence, which is more than the 20 pence nominal value. So that's what we usually sell them for. So we're selling them for more. So 35 pence minus 20 pence is 15 pence. That's what the share premium represents. It's the amount that we're selling shares more than they originally are, the nominal value. So 2 million shares. So the ordinary shares are usually worth 20 pence. I'm going to times by 0.2, which is going to give me 400,000. Now I'm going to take the same 2 million and times it by the increase in the value that we're selling it at. So we're selling at 20p, now selling at 35p, so I'm times it by 0.15 to represent 15 pence. So the share premium is going to go up by 300,000. Okay, so now what does this mean for our statement of changes in equity? Well, our issued share capital has gone up by 400,000. Well, so our share premium's gone up 300,000. It hasn't affected our retained earnings, and the total of this row is 700,000. Profit for the year, this is easy. Where's the income statement? Well, it's here. I'm just going to look at the profit, 431,152, and we're just going to put that into our retained earnings. It's not going to affect our share capital anyway, so the total of that column is just the same as the profit. Okay, dividends paid now. Okay. Let me get some paper just to work this out. So, the directors paid a final dividend of 2 pence per share. the dividend was paid on all shares in existence at that date. So this second sentence is very important. So I just calculated 2 million new shares, if you have a look. So number of new shares, 2 million. And as you can see, if you look at the 2 days, 30th of April, 1st of April, this is happening after that rights issue. So we've got a lot more new shares, so you need to take that into account. So first of all, let's count the number of shares in existence. So I did have 6 million, and then I introduced 2 million more on that 1 for every 3 in existence policy we made. So that brings us up to a total of 8 million shares. That's not a value, that's just how many there are. So I've got 8 million shares, and it says 2 pence per share. So we're just going to type in dividend. And that's simply just going to be 8 million times by 0.02. 0.02 represents the 2 pence. So that's going to give me 160,000. So that's the value of the dividend we paid on the 30th of April. Now, you'd think plugging it straight into the statement of changes in equity is a good idea. But first of all, let's just go back to the the list of values we were given earlier. And we paid an interim dividend this year as well of 120,000. So what we simply need to do is just add on that 120,000. So we paid 2 dividends this year, which brings us to 280,000. So all we need to do now is just put that into our statement of changes in equity. So we paid a dividend, so it's going to come out of our retained earnings. We're losing money. So now we're just going to sum them all down to the end of the financial year, so essentially our carry down. So that's 1.6 million. That's going to be 600,000. This comes to 102,742, and the total is 322,742. So it's actually quite a simple statement of changes in equity. As long as you're comfortable in calculating the rights issue, just make sure you know the difference between the value of the shares and how many shares you have. So just remember that method in a sense. The profit's just straight from the income statement. So if you get that income statement wrong, you're going to get the error carried forward if you put it into here. And dividends paid, very simple. Just make sure you're including the 1 in the information here. Just one way they try the examiners try and trip you up in a sense. So that's question 2. Let's go along to question 3. And this is a bit of a trickier question. So Andy's the owner of a removal business called Murray Movers. The business owns several motor vans that are used to move furniture, and we're given our motor vans at a cost of 90,000, depreciation to date, so that's the provision for depreciation is 30,000. So these two values, one cost take away depreciation, gives us our net book value of 60,000. So during the year ended 31st of April 2013, Andy purchased 3 motor vans in a part exchange arrangement agreed with Robson Motors. So the details are: Andy purchased 3 new motors at a cost of 45,000. He part exchanged 3 old motor vans that originally cost 27,000. So when he bought them brand new, they were worth £27,000, and they had a net book value of £12,000. So straight away from that bullet point, you can take away that 27 minus 12 is the depreciation that those motor vans have received. So those 3 motor vans have received £15,000 of depreciation straight away. We know that. He paid the balance owing for the new motor vans with a cheque for £35,000. It is Andy's policy to provide a full year's depreciation in the year of acquisition, so the year we purchased in, and none in the year of disposal. Having a few technical difficulties here. Depreciation is provided at a rate of 35% per annum using the reducing balance method. That's fixed it. My notes keep falling down. It's rather annoying. So Motor vans at cost, right? So basically, what a T account does, it just tells a story in a sense. We start at the start of the year and then we just get down to the end of the year. So as long as you know like what's happened, what transactions have happened, you can sort of just work through it in a sense. So, well, what did we originally have? We had a brought down of 90,000. Just make sure you know you're working with vans at cost. So there's no net book value in this T account, there's no depreciation, it's just cost. We don't care about anything else. So we started with 90,000 and we disposed 3 vans that originally cost 27,000. So this is going to be our disposal, and this is going to be 27,000. So you see, I've not used 12,000, I've just used 27,000. It keeps it simple for you to understand in a sense. This kind of been nice to you in a sense. So now, we've got rid of we've taken away the value of the vans we've lost, but we need to now add the value on of the vans we've just purchased. So, we've paid for it in 2 ways. Okay, so Andy purchased 3 new motor vans at a total cost of 45,000. Well, we can break that down in a sense because, well, first of all, we paid by a cheque of 35,000. So, bank 35,000. It would have just been wrong to put bank 45,000 because we haven't paid £45,000. We've paid £35,000, and then the other part we paid by the part exchange. So we have another disposal here, and I'll explain why. So this is worth £10,000. Okay, so we've had to pay for these vans worth 45,000, you can see. But so far we've only paid 35,000. So we've had to. So the vans are worth 45,000, but we've only paid 35,000. So we need to add £10,000 on to make sure that we took into account the full cost of them vans in a sense. So carried down is 108,000, and our 2 totals are 135,000. Same on the credit. So the brought down, which is always going to be on the debit of an asset account, is 108,000. Okay, so now the provision for depreciation. So what is depreciation? It's an expense. What side do expenses go up on? Oh, no, sorry, provision depreciation, sorry, my mistake. Provision depreciation counts against our assets. If assets go up on the debit, if depreciation is counting against that asset, it's going to go up on the credit. So the brought down is simply, it's just the same as what we did with the motor vans. We just took the information from here and just stuck it into the start of our T account. So we have disposed of some depreciation. We've got rid of some vans which had been depreciated in previous years. So this is once again going into our disposal, which we'll put in all these disposal entries into this account later on. So I said it earlier, how much depreciation did we lose? Well, it's simply 27,000 minus 12,000, because cost minus net book value gives us our depreciation. It's just been rearranged in a sense. If you added net book value onto that side, took away depreciation, you get cost minus depreciation equals not net book value, which we all know. So 15,000. So what I've done here is just do 27,000 minus 12,000 gives me 15,000. So I've disposed of £15,000 of depreciation. Now, however, this is just the depreciation for previous years. Like I said with question 2 in the income statement, the provision is previous years, it's not this year. So how am I going to calculate it for this year? Well, I have a cost figure here, because we always calculate depreciation on what we have at the end of the year, don't we? So my brought down, so I have a cost of £108,000. Okay. Now, I need to take, it's a reducing balance method, isn't it? So we take away the provision for depreciation and then times by the percentage we're given. So I need to take away a provision, so I'm just going to abbreviate that. So what's my provision? Well, it's going to be 30,000 minus 15,000. Because if we were to finish this account off right now, it would be a carried down of 15, wouldn't it? 15,000 to equal the two sides at 30,000. So I'm going to take away 15,000, which brings me to 93,000. So now, how am I going to get my depreciation from this figure? Well, essentially, it's just depreciation divided at a rate of %. So what's this? It's just the same as divided by 3, isn't it? 31,000. So this is our depreciation charge for the year. So what does that represent? That's what will go in the income statement, in a sense. That is the expense that we'll be putting in our income statement. So what we can just put here is income statement. £31,000. Because in the income statement, the expense will go on the debit, won't it? So we need to put it in the credit of our provision for depreciation account, can't we? So now we have a total here of 61,000. So we're going to need a carry down here of 46,000 to make it balance. 61,000 again, and a brought down figure of 46,000. Okay, now disposal account, you may never have dealt with one before, but they're actually very easy. What you essentially need to do is just make it equal itself. So there's going to be no carry down or brought down in this. So we're going to start off, basically we're just taking all the transactions we've got in the other two T accounts that have disposal on them. So here we have a disposal on the credit of 27,000. So I'm just going to put MV at cost, because that's the name of that account. I'm just going to put 27,000. Okay. So what does this side represent? It represents how we paid for that 27,000 in a sense. So, well, no, that's totally wrong. Sorry, it represents. Sorry, it does. It represents how we paid for this new. How it's got its value in a sense. So we have our depreciation figure here of 15,000. So that was on the debit. It's going to come down to the credit here. So I'm just going to put depreciation. A better definition of what this side represents is the breakdown of the value of this 27,000. So depreciation 15,000. So we also have another entry here, disposal £10,000. It's on the debit here. So we can just put it on the credit of this account, £10,000. Okay, so this side's worth 27,000. This side's only at 25,000. Well, there's actually we need 2,000 from somewhere to make these two sides equal 27,000. How are we going to do this? Okay, so let me just get my paper out. So we paid. They had a net right. So we paid 35,000 from our bank, and we traded in a net book value of vehicles worth 12,000. So bank and net book value, and this should equal 45,000, shouldn't it? But it doesn't. In a sense, what we should do, we should be paying by a check, and then trading in vehicles which are worth the value of the new asset we're purchasing. But it doesn't equal that, does it? This side is higher than that side. So we paid more. We've actually given in more that's worth than we've received. We've paid more than we should have received. They've paid more than what we have received. So this comes to 47,000, which is not equal to 45,000. So this side's too high by £2,000. So what have we done here? We've paid more for something, which is, it's a loss on disposal, isn't it? In a sense, isn't it? Imagine we've sold something for less. Say if we had an asset with a net book value of £1,000 and we sold it for £500, we've lost £500, haven't we? We've made a loss on disposal. So this is going to go in the income statement, and this is just worth £2,000. So I'll just highlight that. That's a loss on disposal, and essentially it's just the 12,000 minus the 10,000. So the 12,000, so that's the net book value, does not equal the 45,000. So that's the value of the I think it's the vans they're paying for, minus 35,000. That's the check we paid. So we've traded in more than what we're receiving, and that's that. Quite a tricky T account bit, I'd say, but as long as you understand just working through each account one at a time, taking your time to think about it, and you should be alright. I understand you all have your exams in the next week, so I wish you the best of luck. Any questions or suggestions to my email. Thanks very much.